from our YouTube videos being marked as advertiser unfriendly and having to curtail the content and the descriptions, the topics, and the guests that we can introduce. So with your help, we can overcome that and break free of that restriction. If you go to patreon.com/reluctantpreppers, you can make any amount of small or modest or larger monthly donation to help support our mission. We've established goals there to help bring you even more content with the different levels that we can achieve together. Thanks, folks. Check it out, patreon.com/reluctantpreppers. And now, on to our main event.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back, Reluctant Preppers. We're grateful to have a returning guest, Jeff Clark, who is a senior precious metals analyst with GoldSilver.com. Mike Maloney's bullion dealership is here with us again on Reluctant Preppers. Jeff is an astute observer for a long time of the gold and silver markets, come from a family background in the precious metals. He's here with us again on Reluctant Preppers to talk about his recent blog entry, Why I Won My Gold Bet with Harry Dent, as well as to address with us topics about the demand that we're seeing in the precious metals market, as well as the gold-silver ratio. So, Jeff, thanks for joining us again here on Reluctant Preppers.
I'm glad to be here, Dunning, and I've got a couple interesting stories for you today.
I was reading with quite some interest your article about how you won the gold bet, and it basically was talking about, in the face of someone who was a real naysayer, saying that gold is just going to go to a huge dive and plunge a while back here. You said, I don't think so, and I'm willing to bet what? What was the bet that you guys made, and how did it play out?
So, yeah, the story is, back in 2014, Harry Dent, he's an economist, author, and all that, and he's very, very pessimistic on gold. He wrote some very strong... pardon me, some very strong language about gold, saying it's going to fall to $700, $750 by 2016, 2017, on its way to $250 an ounce. And we started getting a lot, this is when I was at KC Research, we started getting a lot of people asking and writing us about this. You know, hey, is this guy, and he had all his reasons why and that sort of thing. So I read his article and I thought, this is just hogwash. I don't believe this. So I wrote an open letter to him, and I offered to bet him. I said, there is no way gold is going to $750 an ounce in the next 18 months. I will bet you 1 ounce gold eagle that you are wrong and that it will not fall anywhere near there. I mean, COMEX pricing intraday at any point in time, it will not fall that low. So it took us like 3 months to finalize the bet. We did, and we agreed at $800, and I agreed to 2 years, give him 2 years for his bet to work. So it took me 2 years to collect. But the bottom line is, as I think everyone listening into this podcast knows, gold didn't even come anywhere close to that. It didn't even break into 3 figures. So I won the bet. It took 2 years, but I did collect, and he did pay up. In fact, he even sent me a little extra in his check for a purchase premium to buy a gold coin. So he was very honorable about it and everything. So, but I won fair and square and clearly, and it was a lot of fun. But I did collect, and I have since bought I bought a gold elk with it. Those new the Canadian gold elk, the one with the 5 nines.
Oh yeah! Oh my gosh!
Like that coin.
Now, you mentioned in your blog entry why it wasn't just a hunch, why it wasn't just emotion that you were willing to take the bet on. It wasn't just bravado. It wasn't just being right. You had some specific reasons why you had that confidence, and can you walk people through those?
Yeah, yes, because his reasons were the main impetus for me to take the bet. Because one of his reasons was, well, gold is really just a commodity today, Jeff. He actually wrote that to me in an open forum in public, saying gold is a commodity, and I'm like, oh, that's a softball pitch, man. There's no way. If that's your reason why gold is going to fall, then I'm going to win this bet, because gold is not a commodity. We all know, listening to this call, that gold is really money. And so I did this chart, and you can look at the article online, but I looked at the industrial use of all the commodities, and they're all around 99%, 100%. Silver is 55%, and then there's
utilized in industry. You're talking about percentages of the amount that's produced that's utilized in industry.
Exactly. Industrial applications, strict commodity use, and gold is at 11%. So it looks silly in this chart, and it looks very clear, of course, that gold is not a commodity. It's really money. So And he had other reasons. He overlooked the cost of production. Gold's not going to go to $250 an ounce because it would completely wipe out the industry. And there's demand for gold, so the industry is going to continue, so it can't fall that low. He said we're going to have deflation, and that's going to be bad for gold. He said that he challenged me to go to a grocery store and take my Gold Eagle in there and try to buy groceries. And, of course, he's confusing money with currency. I mean, everybody knows you can't go to a grocery store and buy groceries with a gold coin, but gold does meet clearly the definition of money. So these were all of his reasons, and I looked at those reasons and I thought, well, if that's why you think gold is going to fall, then I'm going to take that bet, because there's no way that those are a correct diagnosis of what the gold market is all about. So he took the bet, and I won.
Now, when you mentioned the point about deflation can cause gold to collapse, can you walk us through that in slow motion? Because for a lot of people, we've heard numerous commentators on our show talking about the real risk of hyperinflation, as we've seen in certain South American countries or Mediterranean countries, that sort of thing, or historically in European countries. But Mike Maloney, in his book, and what you were reflecting is that several people think what we may see first is a deflationary period prior to any large inflationary pressure. Why is there concern that gold can help to hedge against either way that might go?
That's a great question, because most people do think of gold as an inflation hedge, and it is. But it's not about inflation or deflation. It's about crisis. It's about the need for a safe haven. And the need for a safe haven will be just as great in a serious, true deflation as it will in an inflation. In fact, Harry Dent and Mike Maloney at Gold Silver agree. They even did a video together. They agreed deflation is coming first before there's inflation. How does gold perform during deflation? Well, we only have two really good examples of that. And of course, one is the Great Depression. I think most people know the gold price was fixed then. We were on a gold standard. But the government itself, if you remember, did raise the gold price to $35 after he confiscated gold. And then at that time, it was illegal for U.S. citizens to actually own any gold, but they could own gold stocks. And gold stocks absolutely soared during the Great Depression. I mean, think about it. You had soup lines, you had soaring unemployment, crashing economy, crashing markets, and yet gold stocks were going up 400 and 500% at that time. And those were the producers. Those weren't even the juniors. So the only form of gold that someone could own during the Great Depression soared in value. And then the other big example of deflation is, of course, the 2008-2009 period there, the financial crisis. And gold did initially fall during that crisis. When it first happened, gold fell very hard. But it ended the year up 5.5%, and you just can't say that about anything else. So it was really a need for liquidity. People sold gold because they could, and there was a huge need for liquidity. But as soon as that was over, people returned and bought gold for its safe haven status. And I think that's the point, is that the price could sell off initially in a deflation, especially if it's sudden or unexpected. But its safe haven status is when it will turn around and rise again. So that's what's going to push people into gold, is its safe haven status. So if we did have a very serious overnight deflationary event, gold probably would sell off, and I personally would be turning over couch cushions looking for money to buy more, because that'd be the last chance you'd have. So again, it's an issue of whether or not gold is going to be viewed as a safe haven, and it is. It's not a commodity. It is the ultimate safe haven. So I do think ultimately that even if we have deflation, that's not the end of the game. Remember, inflation always wins because it always gets another turn. So even in a deflationary event, the reaction by government, by politicians, by central bankers, is going to be inflationary in nature. And so if you see a big sell-off, you shouldn't panic. You should be buying, because inflation will get another turn. And if we do get a really bad deflation, that just makes hyperinflation all the more likely down the road. So I hope we don't get that, because that's a game changer. But boy, you'll be darn sure you own gold and silver if that does happen.
Yeah, one thing you mentioned in there was not at all obvious to me. It was a real eye-opener, and if you could just recap it, just in case people missed that. You did say it, but if you could just hit it really hard, is that when people say that in certain situations of volatility, when they see, like, for example, stocks selling off or that sort of thing, they will see, at times, gold and silver selling off as well. And your point is that's because they can be sold. They are liquid assets. They will be wanted and they'll be desired even in those times. People know that they can raise cash when you have to raise cash to cover your, I won't answer the question for you, but it was a real eye-opener for me because it seems counterintuitive.
Yeah. It does, but you said it perfectly. There was a high need for liquidity. There was a high need for cash. It was a very frightening time. We all remember what happened in 2008. It was a scary time. You needed cash and assets and income and things to cover losses in other areas. And gold was sitting right there and you could sell it. And that's what a lot of people did. And so it wasn't because they didn't like gold or gold wasn't going to be any use to me in this environment or anything like that. It was because they had no choice. There was a high need for cash, a high need for liquidity, and they sold it. Now, of course, I'm sure there were some people that panicked and sold it because they panicked. But for the most part, it was a need for liquidity at that time. It was a need for cash. And once that was over, boy, people bought it again, and it shot up and ended the year higher. So yeah, that's a possibility again, but that will not be the end of the game. That will not be the last chapter in that book.
If you could talk to us more, you're talking about a specific kind of a dynamic in a particular year, the kind of a year that could cause a very volatile spike in gold demand. But what are we seeing? What is the current trend in demand? Can you talk to us about the demand side of gold and silver markets?
Yeah, last time I was on with you, I was pointing out that, some of the questions and some of the headlines that we see, demand is falling, and that's so American because it's happening in North America to a certain extent, but it's not happening globally. But yes, retail demand for physical product, coins and bars, in the Western Hemisphere is soft right now. That it is true. It is down right now. But there's a few things you have to keep in mind. First of all, March is traditionally the lowest sales month of the year, and it was low again this year. April was also bad. Physical demand for product in North America was very low in April. So why is this happening? Well, coins and bars are mostly bought by retail investors, and retail buyers like you and I, we're kind of price sensitive. Why would I buy that Canadian gold elk at $1,300 if I think I'm going to be able to buy it at $1,200, or if it was just at $1,200? So retail buyers tend to be a little bit more price sensitive, and so that's one reason. The other reason is because if you remember 2016, that first quarter of 2016 last year was when the gold price really spiked. Demand was up tremendously. We were in runaway mode. Bullion dealers were having a hard time keeping up. It was in runaway mode. So we're comparing the first quarter of 2016 with the first quarter of 2017, and obviously when you have a huge spike in demand and it's near record levels, well, obviously any pullback is going to lead to a headline that says, demand is down. So it is true, sales are down at most bullion dealers, but that's not necessarily a global thing. Sales at the UK Royal Mint in the first quarter were up 20%. We all know China continues to buy, India continues to buy, Russia continues to buy. In fact, retail investment in China in the first quarter was up 30% over a year ago. That's the fourth highest volume on record. And then here's the first story I want to tell you. I was talking with a trader back when I was in New York a couple weeks ago, and this is someone who actually, he works on the sell side. So if you understand that, he's selling gold or selling gold products to the institutional investors or other traders, brokers, advisors, high net worth people, what's considered the institutional world. And all of a sudden he told me, he says, this quarter we've seen a significant increase in interest from this population. And I asked him, really? That's very interesting to me. Why is that? And he said, because high net worth investors are getting nervous. They want to hedge against the stock market that's at all-time highs. They want to hedge against the U.S. dollar that's at, 14-year highs. They want to hedge against government. They want to hedge against, geopolitical concerns. and it wasn't a Trump thing, by the way. It wasn't they wanted to hedge against Trump. It was just the geopolitical conflicts and all the things that are going on, like in North Korea, for example. They wanted to hedge against, possible inflation. So all of a sudden, while retail investors are going soft on their purchases, the institutional world is actually showing greater and greater interest in buying gold now for those very reasons. So I thought that was very interesting that, you may see a headline that says retail demand is down. There is some truth to that, but it's not the whole story. And at the same time, you have institutions that are expressing a much bigger interest in gold right now.
It's interesting whenever you see, because what we've been hearing over the past several years is accumulation by Eastern Hemisphere central banks, while liquidation and divestiture by Western central banks and governments. So it's interesting when you talk about the basic principles of deep pockets, weak hands selling into strong hands. Usually you see that usually corresponds to low sentiment and the last grinding ends of bear markets. We just finished interviewing Bill Murphy from GATA.org, the Gold Antitrust Action Committee, and he was talking about that we're seeing some of the worst sentiment among those at the individual household level who are holders of precious metals as we've seen in perhaps a decade. And it's been this long and grinding bear market in precious metals. And what's interesting is the correlation that you're revealing from inside sources you have. They're saying we're seeing accumulation at this time into those with deeper pockets and stronger hands. That's absolutely key information.
It is, and it is an East versus West thing to a certain extent. The East is buying a lot more gold right now, both at the government, central bank level, and at the institution or investor level. Here's another interesting story. I talked to another institutional investor while I was back there, and this is someone who's very successful. He works in the institutional world. I met with several of them. They're very, very well off. These are multi-millionaire type people. They deal with other high net worth investors, hedge funds, institutions, brokers, advisors. And this is someone that I know owns gold. I know that he owns gold. But I could tell in my conversations with him that that he really viewed gold more as a portfolio diversification tool, if you will, if you know what I mean. It's like, hey,
sure,
it's good to have some gold in your portfolio. I got the sense that that's why he owned it. So I told him, I said, well, look, I think a little differently. I agree that there's always a place for gold in your portfolio, but at this point in history, this is a time to be overweight the metal, not have an average weighting or certainly not an underweighting toward the metal. I think this is time to be overweight. So what would make you buy more metal? What would make you buy more gold? And I thought he was going to cite all these, reasons like, the World War III or all these, type of things. And you know what he said? He said, if the price goes up. Yeah. And I'm like, what? What do you mean if the price goes? Then again, I had to stop myself from laughing at him because I thought, what the heck? If you think you should be overweight, you should be buying it while the price is low, not waiting until it goes up. That's how you and I think. That's how retail investors think, but not them. And the more I thought about it, the more I realized, oh, I get it. First of all, they're used to dealing with brokers and institutions who have clients, and they're not going to buy something unless it's going up in value, unless it's rising in price, right? They're not, why did you buy me gold when it was flat or going down? That's what they would hear, so they're not going to buy it. So I understand that. But it also means he's waiting for the price to go up because at that point, that's when things are going wrong.
Right.
That's when something big is happening. That's when there's a crisis, and now it's time to buy into the momentum of gold. And I don't necessarily agree with that strategy, but I'm just saying I simply understand it. The point I think is important to realize, though, is that when we do see gold start to go up, I have firsthand evidence from people who have told me that's when they'll start buying it.
Right.
So I think when a new uptrend starts, it's going to be a new uptrend. It's going to be a new bull market. It's going to keep going because this group is just then going to start getting interested in buying it. And so that's a good thing to know is when it's in a decisive new market or it breaks out, however you may define that, that's when this group of investors is probably going to pour in increasing numbers too.
Yeah, and the other chance you're talking about there, momentum trading or momentum buyers, speculators, are banking on the fact that there will be a system in which to do that, be able to do that flipping for a quick profit, whereas value holders who are using it as a hedge are also concerned, as you mentioned, that they need to be accumulating something that is not going to be subject to the inherent risks of potential catastrophic collapse of that system that's been, allowing those the multi-leveraged and derivatives and everything like that are all behind this market that may not be there to allow you to do that quick momentum trade that people are waiting to get a chance to do.
The greater the crisis, the more this group of investors will buy. They'll continue buying, and they'll buy more. But you're right. Supply is going to be an issue. You and I talked about that last time. Virtually every analyst sees new gold supply declining starting any time from now for the next year or two and lasting for 3 to 5 years, some say a decade. And, of course, you're buying at a much higher price, and you may not be able to get it as easily. You're going to pay higher in premiums. You're going to be scrambling. That's not the scenario under which you want to be buying gold. So in that sense, retail investors like you and I and everybody listening, we're a whole heck of a lot smarter by buying it now when the price is lower.
It takes being willing to be contrarian in that sense of being out of step with where the magician is distracting the audience over here and saying, look at that nicely inflated stock market and how it's getting bigger and bigger and setting records every year. It takes a lot of stamina to basically say, I'm not going to follow that misdirection.
I don't think that people should be concerned about where gold is going. You mentioned Bill Murphy and some of the people he's talked to on the retail side being a little discouraged. I mean, let's review real quick, okay? The stock market is at all-time highs. Real estate is getting bubbly again. In fact, in California where I live, real estate values now are higher than they were during the 2006 bubble. You have the U.S. dollar at 14-year highs. You have inflation at all-time lows. You have bonds in a huge bubble at 35-year lows for yields. You have nominal debt levels that have never been higher. You have crazy geopolitical conflicts. I mean, real interest rates are probably going to go more negative because inflation is probably going to be a real thing, and the Fed is thinking they're going to raise rates. You have negative rates in the EU that still haven't let up. You have the VIX at a 10-year low. Did you see that? The VIX dipped into a 10-year low earlier just this week. Gold usually rises when the VIX spikes, and the VIX is at an abnormally low level. So that's going to change. You have Trump's inflationary policies. He's talking down the U.S. dollar. How crazy is that? You have potential geopolitical conflicts. You have the likelihood of a recession. We're approaching the third longest economic expansion, the period between recessions, since World War II. I mean, a recession is inevitable. It's going to happen sooner or later. You still have countries creating currency out of nothing. Deutsche Bank says the balance sheet of the 4 largest central banks in the world, U.S., Europe, China, and Japan, should be pushing the gold price to $1,800. Someday the balance sheet and the gold price have to reconcile. You have industrial use growing for silver like crazy. The Silver Institute just put out a report with all these new uses again for silver, all these new applications. Is there really any doubt that where gold and silver are headed? Is there any doubt why someone would need to own gold and silver right now? All of these things point to either some type of crisis or a huge bombshell in terms of the price going up. So I don't think we should be discouraged. It's a buy and wait game. It's an accumulation game. And someday we're all going to be darn glad we own lots of gold and silver.
Now, you just gave us a litany of sort of a natural reality check of gold and silver versus all other types of assets and indicators. But even within the sphere of gold and silver markets, what is going on with an unnatural relationship of the ratio between gold and silver?
That's another good point. The gold-silver ratio clearly favors silver right now, and any reversion to the mean.
Now, can you clarify for our people, when you say it favors silver, it makes it sound like silver is being favored, but it's just the opposite of what you mean. You mean it favors the potential future for silver because it's being so unfavored right now. Is that what you meant?
Right. The gold-silver ratio is high, meaning gold is expensive in relation to silver. Silver is inexpensive in relation to gold. The gold-silver ratio went over 75 just today as you and I are talking here. That's very high. Anything over 80, and again, all we're talking about is the gold price divided by the silver price, but 80 and above is a clear backup of the truck opportunity for buying silver. It's been as high as 100, but 80 is clearly an area that I would probably only buy silver at that point. So the ratio continues to go up because of, prices are going down. Silver is more volatile than gold, and so therefore the ratio is going up. So when I say it favors silver, that means it's more undervalued and a better bargain right now than gold is. And someday, when that ratio makes up and heads back down to the average of, it depends on what time period you measure it, but anywhere between 40 and 50 is an average, and it's, hit as low as it's been in the 20s in 2011. Of course, we all know it hit 17, 16 at the peak in 1980. So there's a lot of room for silver to run when the ratio reverses. So now is the time to be accumulating silver.
So I'm going to ask you the question you mentioned earlier. You had a couple of stories, some interesting stories. Were those two insider insights you gave us about pent-up gold demand?
Yeah, those were the stories. The one about Harry Dent, but the one about what the trader was saying, that he's seeing increased institutional interest in the past, 3 to 6 months, and then the story of the guy, he's going to buy more gold when the price starts to go up. So, there's a message in all those stories, so I thought they'd be interesting to share with you.
Excellent. Well, before we let you go, do you have any other final thoughts for our audience? And I'll ask you one more question after that.
I am actively buying both physical gold and silver right now. I bought that coin after winning my bet with Harry Dent. I bought that last week. I bought more, both gold and silver, this week. I bought a little more silver today, so the price is going down. So I see any dips in price, and we're currently in a dip, as a buying opportunity. I'm all about accumulation. I want to be part of the wealth transfer. I do believe what Mike Maloney preaches, if you will, that there's going to be a wealth transfer, and it's going to be from people who are used to stocks and bonds and real estate, and a lot of that is going to shift over into gold and silver, into real money at some point. There'll be a correction, just like there has been many times throughout history. So we put out deals almost every week at Gold Silver. We just had a bullion jewelry sale, and we're all sold out right now, but for Mother's Day. But we have deals, almost every week. So getting on our mailing list it really keeps you in tune to what the latest bargains are in the market. But I can tell you that everybody at Gold Silver, on the editorial staff, all of us continue to accumulate very regularly.
Jeff, if people want to find out more of your work, I was quoting from some of the stories that you listed in your most recent blog entry, but if they want to find out more of your excellent articles, where can they find them?
It's very simple. Just go to goldsilver.com, and then on the homepage there, you'll see the Knowledge Center, and you click on that tab, and you can go down to the Gold Silver blog, and you'll see all kinds of videos and articles and news in there, as well as the story about my bet with Harry Dent.
Okay, Jeff, now you mentioned you and a lot of the other at the staff of goldsilver.com are accumulating. We've had people comment on videos in the past basically accusing anyone who I've interviewed who is in either the production or marketing of gold or silver as being duplicitous. If they're trying to explain why it's so valuable, they say, if it's so valuable, why are you selling it? Well, the difference between someone who's a holder, an investor, an accumulator versus someone who's actually performing a broker function, actually providing a market for that. If you could just clarify for people, you personally are accumulating it, Mike Maloney is accumulating it, but gold silver is, I won't answer it for you. Go right ahead. See if you can help.
Well, gold silver is a broker dealer. We do sell gold. We only sell gold and silver. We don't even sell platinum and palladium. We don't sell numismatics, rare coins, and stuff like that. We only sell bullion, which has, for the most part, very low markup. So you have to sell a lot to make enough money. But the difference with gold silver is that I can tell you firsthand, our money is where our mouth is. And when Mike says he's buying and accumulating, I can tell you that he is. And everybody else there, everyone is accumulating a lot of physical bullion right now. But yes, we are a for-profit business, And what we do with our profit is they pay people like me to write articles for them, and Mike produces his Hidden Secrets of Money video series, which is very popular. He's done 7 of them now, and those things are not cheap to do. They cost like $250,000 each to produce. So that's how we spend our money. But yeah, we're for profit. This is a capitalist business, and we are out to make a profit. But if you look at the website, you'll see that our prices, we have a price match guarantee and all these things. We have extremely competitive prices. We're very hard to beat in terms of the price. But we spend a lot of time and a lot of resources, quite frankly, on education. I think that's a difference you'll see primarily between our website and most other bullion dealers.
Well, Jeff Clark, Senior Precious Metals Analyst at goldsilver.com, thanks once again for joining us here and with your insights and your information.